Hey everyone, let's just dive straight into this explainer. Today, we're systematically deconstructing exactly how true market bottoms are actually formed. If you've been watching the financial markets lately, you already know it's a wildly volatile ride out there. But today, we are completely ignoring the rumors. We're tossing out the gut feelings, we're looking strictly at the data, using the K-line blueprint to finally see through the fog of all those flickering candles.
I know so many of you are out there staring at bleeding accounts, and you're constantly wondering, is it finally safe to jump back in? Can I recover my losses now? It is literally the most urgent question on everyone's mind when the market is just plummeting. You see a massive drop, the prices look incredibly cheap, and you can't help but ask yourself, is this it? Have we finally hit the absolute bottom? I completely understand that deep fear, and honestly, I get the lingering hope that comes with trying to catch a rebound right when there's blood in the streets. Our source material actually captures this perfectly. It says that when the market feels like a pool of stagnant water, trapped in a relentless, grinding downward trend, it really plays tricks on your psychology. Retail investors almost always try to buy at the absolute lowest point, just praying for a miracle reversal. But as we're going to see, relying on hope is incredibly dangerous. So here is our roadmap for today. First, the false bottom trap. Second, reading the smart money. Third, single and dual reversals. Fourth, three-candle reversal formations. Fifth, structural bottom formations. And finally, strict rules for entry. Let's get right into it. Section 1, the false bottom trap. The cruel reality here is that guessing the bottom based on your emotions almost always leads to absolute disaster. Think of a false bottom like a tiny ledge halfway down a massive cliff. Institutions essentially pause their selling, right? And that creates this momentary flatline that lures in eager early buyers who think they're getting a cheap entry. But once that retail money is locked in, the institutions resume their selling, trapping all those buyers and driving the price right off that ledge. It's brutal. Section 2. Reading the smart money. To avoid getting caught in that trap, we desperately need a complete paradigm shift. We have to stop guessing and start actually reading the smart money's footprints. See, true bottoms are constructed by institutional money. We absolutely must visually verify their presence before we risk a single cent. It's all about shifting your mindset from, well, I kind of think it's going to go up, to I have visual proof that heavy buying volume is supporting this price. Moving on to Section 3, single and dual reversals. Let's kick this off with the hammer or the pin bar. Just look at the aggressive rejection of selling pressure here. The sellers tried to push the price down into the basement, but immense institutional buying swooped right in, absorbed all of that supply, and actually forced the price to close near its high. That long lower shadow you see? That's your early warning radar. It's a literal visual footprint of a sudden rejection. Now, with the Doji pattern, we're looking at extreme indecision. The bears are exhausted, and the bulls are fighting back to a perfect tie. But listen carefully. A tie is not a reversal. It's just a pause. The golden rule here, you must always ask yourself, where is the volume before making a move? You absolutely need the next day's volume surge to prove that the bulls actually won the war. The bullish engulfing pattern, on the other hand, is a definitive statement of control. Yesterday, it was total fear. But today, aggressive institutional buying steps in so heavily that it completely swallows yesterday's downward progress. It's just this brutal, instantaneous shift in market power. Then we have the piercing line. This shows us that despite opening lower, aggressive smart money stepped up to drive the price deep into the previous day's territory. This is actually a fascinating psychological trap. The market opens low, convincing retail sellers to panic and dump all their shares. But the smart money is right there, scooping up absolutely everything and driving the price sharply upward to close above the halfway point of the previous red candle. With the bullish harami, the bleeding is completely contained within the prior day's range. That large red mother candle basically halts the momentum, and the smaller green candle is safely cradled inside it. This selling pressure has entirely evaporated, acting as a highly critical dynamic support level. The floor has officially been found. The tweezer's bottom shows the market testing a very specific price point across multiple days and completely rejecting it every single time. That flat line of matching lows, that's no accident. It's a hard defense line drawn by large buyers. But again, a quick reminder. Do not act until you see that corresponding volume spike confirming the reversal. All right, Section 4, three-candle reversal formations. When a reversal takes 3 full days to formulate, the signal carries a whole lot more structural weight. The morning star is a classic accumulation phase. Day 1 is total panic. Day 2 is your gap down indecision. And day 3, that's the confirmation. The green candle surges upward with heavy volume. Undeniable institutional liquidity gets injected into the market, and the downtrend is officially broken.
When you spot 3 red soldiers, and keep in mind, in Asian markets, red actually signifies a bullish up day, you are watching sustained momentum building. This is 3 consecutive bullish candles pushing consistently higher, closing near their peaks with no long upper shadows. It's essentially a relentless upward march, proving beyond a doubt that smart money is heavily accumulating. Section 5. Structural bottom formations. If micro patterns are the bricks, structural formations are the foundation of a brand new bull market. But here is exactly where so many traders get caught out. A true W bottom is never confirmed at the second dip. Traders see the price hit the bottom twice and they buy immediately. But without violently breaking that middle neckline on high volume, it's not a W bottom at all. It's literally just consolidation before another painful drop. This head and shoulders bottom is the ultimate institutional trap and reversal structure. It exhausts all the sellers at the head before driving the price right through resistance. The left shoulder shakes out the weak hands. Then, that deep plunge to the head creates total despair. After that, the higher right shoulder forms quietly on lighter volume as institutions accumulate. Finally, that explosive volume breakout above the neckline, that is your absolute golden ticket.
Section 6. Strict rules for entry.
Now, knowing all these clinical patterns is completely useless if you don't have the discipline to execute them properly. These are the unbreakable laws of this explainer. You identify the structure, you demand volume validation, and you always wait for the final closing confirmation. Never try to anticipate the bottom. Let the bottom prove itself to you. Volume is literally the only truth teller in the financial markets. So, the next time you feel that overwhelming urge to try and catch a falling knife, I want you to look at the data, not your emotions. Are you making a blind bet based on a gut feeling? Or are you executing a calculated trade based on the strict, visually verified footprints of smart money? Let the institutions build the foundation first. Thanks so much for joining me on this explainer. Stay disciplined out there, and I'll see you in the next one.